Let's bring in our first guest, David Tisch from Box Group. How you doing, David?
Hi guys, how are you?
We're great.
Congratulations on having a new job today.
I do. Yes,
Exciting.
thank you. I'm taking it from part-time, 50 hours a week, to full-time, 100 hours a week, but it's only up from here.
Are you hiring?
We are
Always.
hiring.
Always.
How do I pursue this?
Yeah, the VC to full-time
Right.
news anchor
Yeah.
pipeline. You know, once you've done it all in venture,
Yeah.
you know, like you have, the
I mean,
natural step
when
is
you
just-
when you start in this industry, I feel like that's the ambition, a daily show that you can pontificate across the whole industry. So
Yes,
you,
well,
well, we're hoping
now
to
achieved-
we're hoping to recruit you to be, you know, once a
regular.
week, drop in. We will be your podcast.
Yes,
You don't have to
this
pause.
is actually, like, jokes aside, like the way that you like work for us is that when news breaks, you bring it to us. When something happens that you have an opinion on, you come on the show and you talk to us.
You
And
are
that's really the
elevating
goal.
the venture capitalist way to. We don't have news. We don't have things that happen. I feel like you are really playing to the audience.
What about like the most complex and knotty geopolitical conflicts? I feel like you guys as a class are like the best in business.
Overqualified to talk about it.
Oh, okay. So
Yeah.
you want to stay away from politics.
All right, so
today,
let's start
'cause
with
it's
let's
too
start with
much.
tariffs.
Yeah.
No.
Let's start with
I would-
tariffs,
I thought,
Iran,
like,
China,
yeah.
Russia. Let's just go down the list.
Good day
Well, I
in
think
the
it's
market. Everything's great here.
Everything's great. Everything's great.
Have you heard about the accordion effect to early stage? Because that's our famous early stage line of like whatever
Actually, no.
happens in the latest stage market, it's like an accordion all the way to early stage. So it reverberates over the course of 3 to 5 years.
Sure.
So we will not ever be impacted because the accordion basically never reaches early stage because something else will happen in the macro before then, which is a really nice. Don't ask
And
us
there's
any
no
hard
there's no liquidity, so you can't panic sell. Even if you wanted to, you can't
15
hit
years.
the
That's a third accordion ripple.
Yeah.
There's liquidity.
I mean, there's no better example of that than we have SVB crisis. Interest rates go up. It's the death of venture. We're hearing about, GPs are going to be giving back LP capital. But then, well, would you hear about this AI trend? And all of a sudden, it's time to rip checks.
Saved us all.
It saved us
Chatbots.
all.
Who would have thought?
bots. Yeah. Wait,
great.
yeah. What wasn't there? This was sort of before my time, but there was a whole chatbot era, right? Wasn't there like
Chatbot
pre-AI?
V1?
Yeah.
Pre-AI was like it was supposed to be the thing. It was sort of right. It was just didn't have the underlying tech trend. Is that right?
I feel like the tech wasn't there, but also the branding of chatbot to chat GPT isn't that different, but magically different from a outcome and sort of adoption curve. If you look like the automated chatbots, I think is what they were called for that moment in time. They all fell on their face because they weren't interesting enough, good enough. They were like pre-programmed answers. And then OpenAI releases, in essence, just an advanced version of that in many ways from a consumer positioning. And here we are. And so you are like, the idea of chatbot was right in how you're interacting with the tech. The tech, to your point, just wasn't good enough.
Yeah, 90% of chatbot founders quit right before they strike
So
it
sad.
big.
Right before they sell the OpenAI.
I mean,
for $3 billion.
I don't know if I've actually, we should find some chatbot founder who stuck it out. And
So
is
Hugging
now-
Face.
Hugging Face is the one. Yeah, that's
Yeah.
right.
Hugging
No way.
Face
Yeah,
is the winner. They were in a boot camp for chatbots.
No way.
And pivoted from a chatbot into Hugging Face. So that's your answer.
That's amazing. Yeah, we gotta have it's Clement on the show.
Yes,
right. Yeah,
exactly.
we gotta have him on. That'd be great. So yeah, I mean, to get a little bit more serious, like how are you processing this year? What are you actually excited about? What is fatiguing you in venture these days?
We have our annual meeting tomorrow, so
Okay.
I'm in the middle of practicing our script on the market, so I can
Sure.
just try it.
Please, I would
Perfect.
love to hear that.
Audience.
I love AGMs.
Yeah, the pre-liberation day, post-liberation day market speech is different in some way, but you really like, I don't know, you're investing at the earliest stage of a journey and trying to attach two people starting a company with big long-term 10, 15-year ambition to some moment in time macro or what today feels like an incredibly volatile macro where you actually can't even understand what stability looks like or a new framework. Like it's impossible. And so the day-to-day job here is we meet people, we get really excited about what they're working on, we give them money, and we wait 5, 10, 15 years to see how that all plays out. So the investment moment of investing in an early stage company feels totally decoupled from the macro of what's going on. The macro does impact the companies you invested in years ago as they come to market for more money, as they figure out their, revenue retention. But the sort of day-to-day volatility, I don't think has an impact on our day-to-day job of funding great people, starting big, ambitious visions.
Do you think that there are going to be stories from this tariff cycle that are like what happened in COVID, where everyone was like Airbnb was particularly hurting as a startup? I mean, they were public at the time, but I still think of them as like a YC company, right? And it seemed like that the story of Airbnb was like COVID was a transformational moment for them, and they emerged like a stronger company than ever. Do you expect that to happen to any startups, maybe in your portfolio or just out there in the market, that are getting beat up but might emerge stronger than ever?
So like if you isolate tariffs, that has a
Sure.
impact on a subset of companies very outside of software in many ways. I think there's software companies that involve logistics and shipping that definitely are impacted, but I don't know that the like come out of the tariff is a predictable framework. Like, what does that actually mean? Do we get to free trade in reality? Do we get to some equilibrium? Is this China only that we're talking about? And I think within there lies a very hard to foresee, again, point of stability. Whereas at least in COVID, if you said we return to a normal world, that was a more predictable endpoint. If you assume, early in COVID, it was wait 2 weeks and then the world will start again. And then it was some longer period. But I think there was an appreciation for what coming out of it could look like. Whereas I think right now you're in like the creation period, harder to guess. The easy guess is like American manufacturing windfall, but that feels like a big stretch. Like no one's building a factory overnight. I feel like that happens in other parts of the world, not here.
It does feel like it could be a catalyst for the American dynamism companies, the reindustrialized companies that have been placing that bet and kind of hoping for just a little bit of a boost. That you can see a lot of like, oh, that Series A company went to Series B like a little bit earlier because of this narrative. And then that was enough to get them over an awkward hump, build some real infrastructure out, and kind of like realize the vision.
Well, I think
I've been like cautiously optimistic
one
that's one of the dividends from this.
If you're a super early stage investor, which Box Group is, and then you're trying to time markets by being like, oh, there's tariffs, let me make a bunch of supply chain related or manufacturing investments, but then the company's not going to mature for 5 to potentially 10 years. So it could be a totally different environment. And one example that was relevant, we had the CEO of Astranis on last week, which I imagine you invested in like at least over 5 years ago.
13 years ago.
13 years ago.
Overnight success.
And so overnight success. And that's like a good example of like you couldn't have you thought that space was going to be important at the time, and we
knew actually we're early stage VCs. We didn't
crystal
think.
ball.
You knew crystal ball.
Obviously. Yes. No, I mean, like if you think about AI, we're the earliest investor in a company called Clay, and Clay created a vision, had a product, and it was in need of AI for it to work, and it wasn't created yet. And so if you watch this 7-year overnight success, it clicked when the underlying technology caught up with what the go-to-market product was. And I think you see that a lot of the times that the founders who are early in a space and can see it through and wait for the world to come to them while they're sort of pushing the world to get there, that's where a lot of that magic is. And I think Astranis or Zipline, again, 14 years ago, we funded Zipline.
Wow.
Is another example.
We are huge
and-
Zipline shills now that we talked to the founder. I mean, what an incredible story.
We left.
Crazy.
Yeah, we left that conversation. We were basically like, would
Bu-
invest
buy
at
at any price.
Yeah.
Yeah, because I mean, he it's not just that he's been grinding it out for so long, but I feel like if you watch the launch video, like he paints it's the opposite of the Black Mirror vision. It's a very positive vision of the future, and it's something that, yeah, Jobs not finished. He's going to be doing that for 20, 30 years easily. Like there's so much to do, and now it's just a matter of manufacturing, scale, economics, all the basic stuff. But like he's got the drive.
We went to his office on a recent trip to San Francisco, and I probably hadn't been in his office in a decade.
Yeah.
And we walked in, and it was just like this jaw-dropping, American-built hardware, software combo.
Yeah.
That you walked out of there and said, "This is the beginning of another 15-year vision."
Totally.
Was there, looking back at these companies like Zipline, Astranis, was there ever a trend over the last 15 years that you were tempted to go all in on? Because I imagine there was a lot of investors of that era that said, "Oh, space is so cool, I'm going all in on it. Climate tech is so cool, I'm going to do this.
Crypto,
instant delivery,
just NFTs.
Just NFTs.
Yeah. That was the one. That was the one. Yeah.
No, I mean, we're generalists. We are founder driven. We find people who have their own vision. I think us as a firm, we should never be in charge of coming up with ideas. We're not. That's not our job. Our job is to give people who have dreams capital and support to help them. John, your company, I think, is the single most heavily debated internal decision we'd ever made at Box Group.
Yeah.
From a moral standpoint, we had to decide if it was good or bad.
Yeah.
And so that was interesting. So we almost pivoted into drugs. That was an opportunity for us. But no, the world pivoted to AI, right?
Yeah.
So I think 2 years ago, we were saying 30 to 40% of the companies we see talk about AI or are oriented around AI. Last year was 90, and this year it's 170%. You don't meet non-AI companies right now. And if they're not AI first, we're attacking an industry by bringing AI to it,
Sure.
Which is slower and stale. And I think that is a forced all-in versus a sort of opted all-in.
Do the different business models that seem to be emerging, does that change the way you're underwriting these investments? I'm thinking about highly CapEx intensive businesses where you're just expecting a ton of dilution, or we've seen some companies that are kind of just doing private equity style roll-ups, but they're raising from venture capital. And I imagine if you're not careful with pro rata or how you're sizing your bets, it could turn out to be we really didn't get the full bite at the apple. But is that something that even matters to you, or is it just back the founder and we'll figure it
out? Private equity roll-ups in venture always ends well. Definitely.
Always. Yeah. I mean, we like to say private equity is just not a mature business, curious. And so there's lots of opportunity for tech people to come in and disrupt it. They don't take it seriously
in that area.
Famously not cutthroat. Famously not cutthroat.
They're happy to leave all that money on the table.
Yeah, exactly. Just dollars on the floor for VCs to come pick up, right, Jordy?
No. I was more. Has there ever? It feels like over the last 2 years, there's been more of these sort of roll-ups than ever before. Was there another kind of general market-wide crack, or was it just sort of individual areas and opportunities?
I struggle to think that the way to build companies is to replicate another company that's succeeding. In these moments, what you tend to have is one winner and a bunch of followers that don't win. And so can there be a single version of a roll-up? If you look at Anduril, they're great at acquisitions. That's a different phrasing of the word roll-up. Roll-up is either we're going to buy a bunch of things that are the same size, or we're going to buy one big thing and then tuck in some other smaller things around it. So I think unpacking the nuance in these words is more important than assuming a general success across a wide variety of companies. I think the like moment in time where you probably saw fast followers or fast movers win was in the on-demand business, right? When Uber trained the world that you could touch something on your phone and something in the real world would happen, it unlocked like a behavior across the world that was very different, right? And that was this phone to real world connection that I think opened up a ton of other businesses. I don't think they all worked, but I do think that that was a horizontal opening versus a business model innovation that has been used in other industries or financial industries and then applied in venture.
Yeah, the idea, the classic sort of like accounting firm roll up, when I look at that, it's like when it's been 2 weeks and my like CPA is not like on it or like is not, like clearly like, is busy with other clients, I'm like, it's not like I want to switch immediately, but I'm pretty quickly. And so the idea that you're just going to buy like 20 accounting firms and then slap AI on it and not have like 90% churn is just interesting.
Yeah, it's rough.
But have you tried AI? I mean, it's pretty good.
Yeah, yeah, it's pretty. It's only going to get it wrong 5% of the time, and that's going to cost you millions.
Yeah.
But
this is a topic that Jordy and I have been debated, and it's kind of related to Uber opening the mindset of like this delivery boom. Chat GPT wrappers, it's been derided as a term. We've now seen the VS Code fork wars, but it looks like there's a chance that OpenAI buys Windsurf for $3 billion. And I've been going back and forth with Jordy about this, like, is this game on for M&A in the wrapper market? Because if OpenAI, who has, great team, lots of money, can't like build it and they want to buy it, then do we see Anthropic? Do we see XAI buying stuff? Do we see Amazon, all of the Mag 7 buy stuff? And then maybe even, you get into some of the just Fortune 500 companies that want to buy startups. And so I'm in this weird scenario where I've been somewhat accepting of the idea that a wrapper might not be a power law outcome, but everyone involved in Windsurf, if this deal goes through, will do very well. And so what is your take on that market, and does this narrative shift?
My take was broadly that like, this is highly strategic for OpenAI, but that doesn't mean every wrapper, even if they have a lot of traction and revenue, is like suddenly strategic to a wide range of buyers, right?
Sure.
So I think in my 15 years doing this, the thing I've I overrated was the amount of M&A that would happen. I think if you go back in the early growth of like this era, if you look at anything from Facebook and before that, Google, Yahoo, Twitter, on their way up, they bought tens, if not 100+ companies. Wow. And a lot of that was for stock. And it was stock that appreciated post-acquisition, incredibly valuable for both the company and the founders who sold. And I think if you look at the next wave of startups, a dramatic decrease in M&A, because instead of buy, you build. And the acqui-hire didn't prove out to be the best use of equity. A lot of the decision of buy versus build became easier as you thought about where to innovate. I think in sort of getting at your question, I hope we're entering a period of M&A. I think the easy way to rationalize it is the valuations of some of these companies that you mentioned are so big that they can afford to buy companies for substantial amounts that might actually align with the founder of the acquired's expectations. And I think that's where one of the other mismatch was happening, is that the company that wanted to buy another company was just not able to hit the price, and so they didn't happen. And so I think one way to rationalize it is whether it's the big seven or the scaled AI companies have big enough valuations to go out and buy things for numbers that will hit a founder's expectation, which I think would unlock, a lot of positive things in this ecosystem. One is liquidity, but two is like there isn't really an answer to how do things end right now for a ton of companies, and M&A is the piece that's been missing to me the most. It gets less discussed, and I think Fortune 500 companies need to modernize, right? And we saw that pressure 10 years ago when you heard like all the non-tech companies are going to become tech companies. And then the public markets punish you on a quarter by quarter basis, and it's like, forget that, we're not going to do any of that. But I think today AI might be such a dramatic forcing function that smart big companies need to move quickly to get ahead of the curve. So optimistic.
Is that buy versus you mentioned, these super acquisitive companies maybe 15 years ago, and then that changed. Do you think that was a factor? I mean, you guys basically, Plaid was built out of your guys' office. There's a lot of there's been so much infrastructure built during the Plaid era. Do you think that that was part of the calculus for some of these bigger, companies that would have been acquirers, but they said, hey, like, we could buy this tech and then maybe try to integrate it, or we could get this team and do it, or hey, this infrastructure exists and we can just build it ourselves?
You had so many factors. Like the biggest one to me is that the government didn't want big tech to buy more companies. And so if they were going to buy companies, they had to be like the biggest ones, not like they were going to fight the regulatory fights on big companies, not on small ones. And that dried a lot of it up. And then I think the valuation expectations was the other friction. When a startup decided they were worth $500 million and the potential acquirers wanted to buy them for $100 million, that was no longer interesting. And so it decoupled rationality from playing out in the M&A world, right? You have to have like a buyer and seller meet on price in order for the deal to even get going. And I think that's where the biggest gap was. Plaid sold, right? Plaid sold and the government stopped it. And I think that was, to me, a interesting moment in the government getting involved in something that was debatable. And I think it also tells big companies, like, don't waste your time trying to get these things through. And that slows down a whole wave of potential M&A.
Interesting. I don't know if the M&A market relates to what you're seeing on the LP side, but we've heard that there might be some fatigue from LPs on what's going on in venture. But at the same time, it feels like that David Goggins meme where, venture just keeps on chugging no matter what. You're going to the AGM. What are you seeing broadly in terms of LP appetite for ever bigger venture funds?
We're a small, adorable seed fund based in New York City. So we are not responsible to answer that question. I think your job, if you take LP capital, is to give them back a lot of money one day. Yeah. And I think if you haven't, you owe that to them. And so at some point, the patience should run out. And I appreciate that. I think the challenge is the time for liquidity in early stage venture has gotten pushed significantly from where it was more predictable a decade or 2 decades ago. You could say 7 to 10 years on an early stage fund and mean it. Today, I think you say 7 to 10 years and you're like, by that, I mean like 12 to 15. Yep. And that's a substantial difference. Yep. And I think you need to align with your investors on what that timeline is, because it's an irrational timeline. Like the people we fund, if you go back 15 years, they were like pre-elementary school for the most part, right? Like if you look at the young founder that you're investing in today, a 15-year timeline is 2/3 of a life. Like it's an irrational number. And so these like the go in motion of making an investment to the return the fund to LPs timeline is so decoupled from, I think, a psychological standpoint that your stakeholders are just dramatically unrelatable.
On that topic of like young founders, how has the early stage market evolved? It feels like there's a lot more products. Like YC is bigger than ever, but then there's also Z Fellows. There's different fellowships. There's people that are just giving away money to people to like go try a startup, and then maybe I'll invest later. And obviously the Teal Fellowship's kind of like a scaled version of that, but there's a lot of other, initiatives. How has that changed your strategy? Has it changed your strategy at all? And kind of like what does the early stage market look like for you today?
I think there's always been these splashes of noise, and very, very little. Like if you go back again, I'm old, and so I've been doing this through these micro waves of change in the early stage market. Very few products stay where they are. They move in different directions. They either get later. So if you think about new entrants as funds into the early stage market, most of the ambition is to become a bigger fund. And in doing so, you become later by nature of scaling your business. And I think on a product side, you're only as good as the product you're offering. And so what has been amazing to me about YC is they've just continued to compound quality of the satisfaction to their customer. They are not free, right? You're giving YC equity, and yet if you look at like the happiness factor, the MPS or whatever cheesy acronym you call reviews, but like people go to YC because other people who went to YC loved it, and they think it was entirely worth it. And so I think the products that get invented need to live up to the cost. And if the cost is free, like nothing is really free. And so what comes with that freedom? Is that attaching to a brand? And if you attach your company to a brand, is that a good thing to have done? Or is there some negative externality that comes with that? And so I think, and it's probably not the end point for the products that are offering free capital to be free forever. I would assume that's a hard thing to scale. And so I think you have to just like, as a company, aligning yourself with the brand, the trusted brands have proven to be trusted for a reason, and the new ones need to earn that. And I think there are some that have been around long enough where you find good examples of quality coming from them, and those are the ones that I would tend to trust more.
You've been in the game for a long time. Can you tell me the story of your first investment ever?
Yeah. Our Box Group is named after our first investment.
Really?
So it's like a combination. So the first investment's a company called Boxy. It was a Roku competitor. We were in their seed round as an adorable check. I didn't want to write my name as an angel investor, so I created an LLC called Box Group to invest in Boxy, which made me feel bigger. The Box was like a cool nightclub in the city at the time. It felt like a cool word. I've looked with Aaron Levy. He registered Box.net like 2 months before I did Box Group, which I'm bitter about. So at some point, he'll sue me and it's all over.
Well, he's been on the shows too, so he can come on and debate you for it.
Yeah, well, we're all collaborative in this world anyway. No competitors. So Boxy gets funded, follow on by Fred Wilson. I'm like, oh my God, I'm amazing at this.
Yes.
Like I read that guy's blog. This is so cool. And then General Catalyst came in, and then Avner, the founder, went in front of Congress to like fight the cable companies. So it was like an amazing first investment to like see the narrative of a startup. They sold to Samsung, and they were built into like the Samsung smart TV technology. But the idea was right, and the timing was challenging. They had to fight every single battle on behalf of the people that came after them. And I think that was a really good lesson.
Do you see, you have a ton of portfolio companies.
Too many, probably.
Too many, I'm sure, to manage. Do you see, and Case Text is one of them, which is an interesting example because that was a company that no one...
9-year overnight success.
Yeah, exactly. I'll hit the overnight success.
Overnight success.
Are you seeing that across?
Should we get a soundboard for our like meet companies meetings? Like,
you definitely should.
Yeah, you should.
Handshake deal.
Yeah, handshake deals.
Raise your forecasts.
Yeah.
There's an internal bingo that we run that every time they say buzzwords,
we're preempting.
Yeah, but how do you think of AI in the context of the portfolio broadly? Are there a bunch of examples where it's kind of creating new momentum in the business or like tons of new opportunity? I look at this like, I have 50 odd personal investments.
All of them will work.
All of them will work. I'm sure they've all been marked up. So I'm sure
that's what the Sequoia website told me, which I was like, I can be 98% successful. Is it?
98% hit rate. But how often are you seeing it sort of create momentum versus momentum just being something that once you lose it, it's really hard to kind of get it back if you're not getting, sort of lucky?
I mean, Case Text is like the most amazing story. What a grinder into just being early in the right way. And I think to Jake's credit, he was always like the smartest person in the room and figured out how AI could come into what they were building in a differentiated way and like split a team off, built a product, got to market first in an industry that was ready for it. And so I think it's this, and he landed an outcome that he changed his life and changed the team's life. And I think like a unique story. We're now like 3 years past that. You're early to the game. And so if you haven't figured out how to take your stale product or your product that's maxed out and begin to re-energize it, it feels like you're a little late. There are those stories. And I think Clay's the other side of it where AI happened and Clay benefited from sort of the speed of it and now is running. But I think within the portfolio, there are companies that benefit from pieces of it. And whether that's on the cost saving side or the growth side, I think you can find examples of everything. But it's within the verticals that I find the most interesting momentum just being recreated, right? It's companies that are servicing customers. And in some way, if they can be the deliverer of AI to an industry that can't get it themselves, that's a really big opportunity. And I think Case Text sort of represents that.
Yeah, that makes sense.
It's awesome. Thank you so much. This was a
Wait,
fantastic
I came on here to
conversation.
promote something. And
Let's go.
Yeah, give us a call to
you guys are
action.
like the
Show
Howard
it.
Stern of tech. And so when you go on Howard, you have to promote, or like the late night shows,
Let's
you have
do
to
it.
promote.
Please,
So
yeah. What are you
we have a
promoting?
conference that we're putting on with Union Square and First Round in Lux in New York called Founders NYC. And it's foundersnyc.co. It's free, which is different than most conferences. It's for people who want to start a company. We got the founders of Datadog and Mongo talking to each other on stage.
That's
sort of,
awesome.
to me, a collection of all of the big, great early companies that were built and scaled in New York coming on stage to just like sort of create the community effect of building here.
Awesome.
And so if you're
do you want to take a victory lap on NYC just generally? I feel like no. I'm just saying when you started Box Group, a lot of people
it was very,
like maybe
no one had heard of. We're like the pioneers of New York City.
Yeah, no one had heard of New York City before.
There was that era.
But
No, but
it's true about tech, right?
The amount of the capital concentration in New York City right now is incredible. It
So
feels
many
like
great
it's
companies.
never been more.
We're like the pioneers that discovered Miami in the COVID era.
Yeah.
No.
No.
But look, I think New York's a
great.
home for people that want to win. And I think whatever you do in New York, it's like an incredibly harsh environment. And in order to stand out and win in New York, you have to fight friction. No one cares, right? And that's what's actually fascinating to me about tech in New York is like, if you went on a subway or to the restaurant nearby, nobody cares what you're doing. Like no one cares about your business. No one cares about tech. And I think that friction creates people to have to fight a bigger fight here because there's not momentum. Like there's not somebody pulling you up and saying like, we're all in this together. And so I think the community here is just like people put their head down and grind. And it's produced some real success. And we're excited to put it all on stage.
That's amazing.
Well, thank you guys very much for having me. I'll see you tomorrow.
We'll see you back. We'll see you back here.
Talk to you soon. Bye.
Cheers.